Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, Bill talks with Chad Braun, co-founder of Fifth Corner, about the nuances of real estate investments. Chad shares his journey from public accounting to leading a public REIT and finally to his work at Fifth Corner. The discussion covers the differences between public and private real estate investments, the concept of irreplaceable corners, and the impact of e-commerce on retail spaces. Chad also explains the importance of demographic data in investment decisions and the benefits of private real estate for high net worth and family office investors. Listen in.
Chad Braun, welcome to Educational Alpha.
Bill, thanks for having me.
A pleasure. The catalyst getting down toward Texas was my old friend, Dave Hicks, who I worked with many, many years ago. And he and I caught up a few weeks ago and talking about some of the challenges and opportunities. And we're going to focus on both, but hopefully more on the opportunity side of investing in real estate. In many ways, playing that, certainly in this current phase of the market. And you've had a very interesting background leading up to the work you're doing with Fifth Corner. But before we get into that, maybe a bit on your background, and we'll take it from there.
Yeah, no, thank you. Always wanted to be in the real estate business. My dad owned a construction company, and so that was my first kind of foray into real estate. So when I graduated college, I took the accounting and finance route, spent about 5 or 6 years on the public accounting consulting side of the business with a firm called Kenneth Leventhal and Company. We then got bought by Ernst & Young. All I did was real estate. Loved what I was doing, but not necessarily where I was doing it, which was all over the country and not sleeping in my own bed, and decided to make a move onto the principal side and met an individual, Carr Taylor, who had at the time, small company, REIT. We were about $50 million in assets, all net lease and shopping center properties, spread coast to coast, mailbox money. I had the privilege of joining him in 1999. And over about a 20-year run, we grew that company from about $50 million in total assets to about $1.5 billion, took it public on the New York Stock Exchange, and then ultimately sold it in a go-private transaction in 2015, which then ultimately led to starting up Fifth Corner in the summer of 2017. So entire career has been spent in real estate, either on the professional services side or principal side. And virtually 100% of that, especially on the principal side, has been in the retail sector.
Just a quick observation on the formative years. Were you on the assurance side of accounting as a CPA track or more on the consulting side for real estate?
So I am a CPA, started off on the audit track, decided that coming in after everything had been done and validating it just isn't really what I enjoyed doing. I didn't get fulfilled in that. And so I moved over to the consulting side of the practice, had an amazing experience coming out of school in the early to mid 90s. We were still on the tail end of the RTC, the Resolution Trust Corporation era. So actually my first assignment with the firm was to fly to Parsippany, New Jersey, walk in the next morning with the federal regulators and lock the doors behind us, close down a savings and loan, and then work through their performing and non-performing loan portfolio. So learned very quickly in my career how things can go wrong, why they go wrong, and what you can do to help avoid some of that.
Yeah, no, interesting lessons learned. And I'm a CPA as well. And similar to you, I never had a passion for public accounting or audit work, as we called it in the good old days. Now it's assurance. But learning how to read a balance sheet is never a bad skill set to have. And it's very, very transferable to many, many different parts of your career later on. So an interesting point to the CPAs out there. So maybe before we get to Fifth Corner, and maybe leading into it, having worked maybe in more the tradable side of the real estate space, if I understand AmREIT correctly, if you could just talk about the differences and maybe what is alike between publicly traded real estate through a REIT versus private real estate. And the old adage, and it may or may not be true, if I'm going to get exposures through a REIT, there's a lot of equity beta I'm taking on there, and the correlation to a broader equity index might be very, very high. So I don't know if I'm truly getting diversification there too, but I do have some real estate exposure. So maybe you can start there and then talk about more the private real estate.
Yeah, no, I think that's a great observation, Bill, and a good question. In theory, real estate is not directly correlated with the stock market. It's candidly not even directly correlated with the bond market, although cap rates and treasury yields do have some similarities. The challenge is, as you described, is when you seek to get that diversification in real estate through public equities, you are going to get some of the equity volatility that you speak to. It's not going to necessarily take on a direct correlation to the real estate because of the involvement of just the public equities market. The thing that I found personally most challenging being the CFO and a COO of a publicly traded REIT is the fact that Wall Street operates in 90-day increments. You've got your 10Q reporting through the SEC every 90 days. You have an investor call every 90 days. And the street and the analyst community are benchmarking you and benchmarking your metrics against those of your publicly traded peers. Nothing wrong with benchmarking, nothing wrong with comparison. But the problem is that real estate just doesn't operate in 90-day cycles. And so what may be right by the real estate may be to take on a little bit of vacancy, because you've got an opportunity to really press in and grow rents. But then your occupancy metric may not be on par with your peers. And then you get penalized by the public markets because your occupancy metric isn't the same. That's just one small example of that. So yes, you get the liquidity and the daily liquidity through the public equities markets. But personally, now having sat on both sides of the table, I think commercial real estate in private hands where you're not dealing with that 90-day cycle and you can actually do what's right by the real estate, both in the short term and the long term, without having to worry about, is the stock price going to be penalized because of one metric or another in a 90-day increment?
Yeah, and I think patient capital, regardless of the liquidity window, is what every investor should be thinking about. So turning the page a little bit toward your current remit at Fifth Corner, and we could talk about whether or not that's synonymous to the Irreplaceable Corner, which I think you folks have trademarked. But it's interesting if you take a step back and look at the U.S. economy, it is a consumer-driven economy. And to ignore the consumer's biases and trends, you do that at your own peril. So when it comes to particularly investing in real estate, even if you're not directly on the housing side of the market, and I think if I understand your investment thesis, you're more retail-oriented, there's got to be some correlation of value creation to where the consumer is going and what they want. And the consumer real estate has to be married up against the retail, I would assume, all things being equal. So you could take the other side of that, but maybe start by maybe explaining to me and to the listeners what an irreplaceable corner is. And any square I've looked at, it only has 4 corners, and yet you're the 5th. So maybe you can explain that to me a little bit.
That's right. Well, I'll kind of go in reverse and they tie together. So Fifth Corner is the name. And yes, I will start by saying we do fully realize that there are only 4 corners at an intersection. So I'll clear that from the get-go. Our firm was founded on 2 sets of principles, and we call it the soft side of our business and then the hard side of our business. So the soft side of our business we call our 5 C's. And that really goes into the culture of the organization. You know, Drucker says that culture eats strategy for breakfast. And so we really focus on the cultural side of what we do. But the hard side is equally as important. And we call that our 5Ds. And our 5Ds are our investment strategy and our investment framework. And it's very data driven. It's very demographically driven. And so what we say is where the 5Cs of our culture and the 5Ds of our investment strategy meet is the proverbial fifth corner. And that's the value that we bring to the intersection. So that's the name and where and how that came to be. And then you're 100% right. Irreplaceable Corner is a term that we trademarked. We believe so deeply in it that we wanted to protect the intellectual property around that. And really, at the end of the day, an irreplaceable corner, when you think about real estate and you think about your own markets, and whether it's retail or it's multifamily or hospitality or industrial, whatever it is, it's where the demographics of the community come together. It's where the community comes together, and you're able to create something very special, something that's very lasting, something that has value beyond, candidly, even just what it is in that moment, because it is so well tied into the fabric of the community. It's almost hard to extrapolate one from the other. And from an investment thesis standpoint, we seek to find and identify those irreplaceable corners. And then, as you said, ultimately create value. And we do that through a number of different ways. But it is that tie into the consumer. And I think the mindset that the consumer truly is king. And if you have that as your thought process, then that does dictate and direct where you invest, how you invest, and what the overall value creation initiative can be.
Chad, you mentioned, I forget it was 4 or 5 Ds now, but one of them was demographics. And I think that that's got to factor into your investment approach to a large degree. And I'll use maybe even, I was going to say my parents' generation, but maybe even mine, that I can walk about a half mile down to a retail center of Woburn, Massachusetts, and Newton, where I am. And there's a Starbucks and a dry cleaner and sort of a general store there. I think in the good old days, the risks were that the big box stores would put the corner store out of business. And if I need to buy something in bulk, I'll go to Costco instead of the store down the street. But it seems like the demographics now are really marrying together the retail center with housing. And it's at the bottom of my elevator bank. And the thought of even wanting to go to a Costco, I don't even have the place in my apartment to fit 6 years worth of paper towels. So I think that the consumer's changing. And as I get older, they're getting younger. And I guess that's a fact of life. But their buying habits and where they want to live are changing as well. So how much of this irreplaceable corner is being driven by the demographics of a consumer that, if I look at my kids in their 20s and 30s, might have very different habits in terms of what they want from a retail sector than I might have wanted?
Yeah, and that totally. And I'll take it even one step further, because anytime you talk about retail, the elephant in the room, right, is e-commerce. It's Amazon. So it's not only generationally from the baby boomers to the Gen X to millennials to whatever the generation may be, that there are changes and preferences within those generationally, but also we're in a very evolutionary time. And so when you think about commoditized goods, those things that you were speaking to, if you need 6 years worth of toilet paper, or you need washing detergent to last you for the next couple of years, you can go to Costco, you can go to Amazon, you can do those things. What we have found that, again, really links the community and the fabric of the community, the old town square, if you will, are more of the services that we desire and more of the experiences that we desire. And so your ability to come down out of your apartment, and whether it's in the ground floor or it's in the block across the street, and go and sit at a Starbucks or sit at a boutique coffee shop and read a book or have a date, or take one of your children and to grab a cup of coffee, or have a date night, with your wife at a local favorite restaurant, to be able to go to a hair salon and get a haircut, or go to the dentist or a chiropractor, all of those things, we find that last mile, if you will, between the consumer and in the trade is so important and so valuable. And there are so many things that we can link together, both from a tenant mix as well as aesthetic appearance, that brings those together, that really creates just these special areas that, as you said, people want to live. People want to live in close proximity with the things that they enjoy doing, the things that they're passionate about. And if you can do that in a walkable environment, all the better.
In terms of where you're seeing value, and I don't know if you can contrast pre versus post COVID. I don't know if that's a fair analogy with your business model, but certainly post COVID, people can live anywhere they want to a very large degree, with some exceptions. Maybe financial services are demanding people to be back in the office, and I don't know, maybe make Dave Hicks come in 7 days a week. I don't know what the philosophy is there or not. But I look at certain areas like New York or even Boston and other cities in Massachusetts, they're bleeding out people. But then I look at parts of Texas, particularly Austin and Nashville and Charleston and Atlanta, where there's a lot of migration moving to these areas. So is your opportunity set? Is it in these growing cities, or could you create a fifth corner somewhere in the suburbs of, say, Boston as an example?
Yeah, so I think the answer is ultimately both, because again, you're looking at where's the population growth and where is the employment growth. Both of those things are very critical to a healthy and a robust commercial real estate environment. For us and for what we do, we are focused on Texas and kind of the South and the Southeast. Because those markets are, as you just described, they are the beneficiaries of a lot of in-migration. So you see, whether it's in Houston or Dallas or Fort Worth or Austin, as you look to Nashville and Atlanta and Charlotte, these are markets that have a lot of population growth that, generally speaking, are very pro-business. So the other thing that generates is a favorable tax environment, which helps the disposable or the discretionary income that a consumer has, that ultimately then makes its way into commerce through retail and other things, and that has a very strong employment base and a diversified employment base. Each of those things are key and critical, but I would say that's where we focus. But whether you're in Boston or whether you're in Manhattan or whether you're in Chicago, each market has those pockets, have those submarkets that possess those characteristics of fluence and density and walkability and desirability and favorable demarcation and all of those things that ultimately tie back to what we call an irreplaceable corner.
And hearkening back to the Kaya curriculum, which is my job and trade today, we talk about the concept of green versus brownfield, and the listeners that may not be familiar exactly with those terms, at least the way I used them. Greenfield it's literally a virgin land they're going to build on, versus taking maybe something that was popular 10 years ago and is sitting there, and you now have to go in and update it and rehab it as a brownfield project. So with that, and maybe I blew that definition too, but those rules of constraint, is a lot of what you do in the greenfield sector or brownfield, a little bit of both in terms of opportunity?
Yeah, so we're mainly, under that context, we're mainly going to be in the brownfield. We're not pioneering. We're not going out to the greenfield where it's a little bit of the field of dreams. If you remember that movie, the build it and they will come mentality. It's the tried and true and the proven. And so it is taking what could be historically retail uses or could be some other, light manufacturing and other uses, and adapting those uses to really fit the needs of the community. Some of the coolest projects are some of those adaptive reuse projects where you come in and you're really able to revitalize an area by taking something that may be more dilapidated. It may not have the tenant mix and the tenant categories that the community needs, and coming in and backfilling that space with the appropriate needs, and then to see the revitalization that really takes place within that community and the way the community embraces it and then takes it on as their own is both, I'll say, kind of emotionally gratifying as well as financially gratifying.
I want to talk about the structure in a moment, but so it's a little bit odd starting with the exit, but we're kind of on it now. Once it is gratifying for you and your investors and it comes time to leave, what is the exit strategy for a portfolio company like a retail sector? Who's the next owner?
The exit is a wide variety of folks. There's a lot of appeal from high net worth investors, from family office investors that are tax motivated and may have a 1031 tax deferred exchange. A lot of neighborhood, community, and strip retail is a little bit more bite size than, say, a 600 unit multifamily project or a 10 or 20 story downtown office building. So a little bit more bite size. So one-off transactions that way. The other thing that we have seen and found is as you take these retail assets and create a collection or a pool of them that individually may not be overly significant, but collectively are significant. And if from a quality standpoint, there's some homogeneousness to them, then there's a great appeal from some of the publicly traded REITs, from the institutional buyers, that in order for them to move the needle, they're not going to do that 10, 25, $50 million at a pop. But if you can aggregate 100, 200, 300 million of those assets, then that can be very appealing on a more portfolio level sale to an institutional or a REIT buyer.
So that's interesting. So the conduit approach then maybe brings us back to the start, and as to who are the investors, who are the LPs, and maybe you started to answer that. It might be mostly taxable individuals, high net individuals, single family offices, maybe some small institutions. I don't know, Chad, if there's a way of describing the total addressable market, and is it big enough that a big pension plan like a CalSTRS could invest in it, or they may be more of the conduit on the back end. They may be buying a collection of assets with a REIT as an example at the back end. But who are the typical LPs in a strategy like this?
Again, I think it can run the gamut, Bill, but for us, historically, it has been the high net worth investor, the family office investor. Really, you hit on it, that is taxable. And so they're looking at some of the tax advantages associated with real estate. And that has been our primary LP or investor base. Yes, also some smaller institutions. Most of the institutions that we have attracted thus far have also been taxable in orientation. So some of the things like depreciation and those other things have been important to them. But there's definitely larger organizations that are out there that attract the CalSTRS and the CalPERS and the larger tax-exempt organizations that still find real estate appealing, both from an income perspective as well as from a long-term capital gains perspective, even though they're not able to benefit from the tax advantages.
And your structure is a drawdown fund as opposed to an interval fund or anything else that's giving periodic liquidity?
That's right. It is a drawdown fund, so a capital commitment up front, an investment period that typically lasts 2 to 3 years, and so that capital will be drawn down over that period of time. And then an operating cycle that's generally 5 to 7 years to go through and implement the value creation strategy that ultimately creates the value. There's income that's paid along the way through the operating income that's generated by the property. And then upon the disposition, obviously there is an anticipated capital gain event that takes place to deliver the total return. And along the way, again, for a taxable investor, depreciation shelter that at least historically, given where the tax code is, has been very advantageous with bonus depreciation that shelters a significant portion, if not all, of the quarterly operating distributions that get paid.
I was going to ask you whether or not you would have considered an interval fund, and maybe I'll do that maybe in more of a backward way and maybe less of a direct ask. But these interval funds have been in the news of late, and we're recording this in late May, and there's been another REIT that's run into some issues around an interval fund. And it's a difficult challenge because we're trying to give investors access to a wealth building asset class. And I don't think real estate's necessarily an asset class for reasons that we've already discussed in the last half hour. But giving them access is great. But how do we do that? And how do we explain to them the concept of long-term value creation? And in your current drawdown structure, if you allow these family offices to come out every quarter and you're having to create liquidity, it would undermine the very value proposition of what you're trying to bring forward in the first place. So that's point one. And the second point, I just don't know, Chad, if this gets enough play, but as you take very sophisticated products that were largely available to tax-exempt institutions and you put them in a new wrapper and don't pay any attention to tax consequences, the after-tax returns to the end investor, from a family office down to the average person on the street, can be horrendous. So we have to be thinking about outcomes after tax. And it's interesting that you mentioned that because it's such an important consideration for individual investors. I just don't know if that gets enough airtime. So back maybe to the point, you don't have to comment directly on your strategic plans that go on behind closed doors, but what are your thoughts about how we provide broader access to strategies such as yours? And a fine answer might be, I don't know, but we're not ready to do it yet. And I think that's part of I think, where we are in this cycle.
Yeah, I think it's a great question. And one of the things that one of my business partners says is live the question. I think that is part of your answer, is continuing to walk in that question. I think opening and making real estate available to a broad array of investors is critical. I do think that real estate as an investable asset class carries so many benefits with it, especially to the taxable investor. The current income that it generates, the depreciation shelter from taxation that it generates, and then the long-term capital gain. So it's really a little bit of the best of both worlds. It doesn't give you what a straight or pure equity play would give you, or private equity. It doesn't give you what a straight bond or income approach would give you, but is really a hybrid of the two. And so the more we can make that available, the better. The challenge that you raised at the forepart of the question is liquidity. And how do you navigate that like some of the integral funds are doing? Because you're making a long-term investment in a piece of real estate. And if you have a subset of your investor base that desires liquidity, you can't sell 5% of an asset. You have to sell the whole asset. I think the firms that have done a good job of operating and navigating that are constantly in the market raising capital. They're setting aside capital reserves for liquidity, putting some limitations on that liquidity so that they can fund that through the capital flows. Now, when capital flows close, then that creates challenges on the liquidity side. So I do think it's important for investors to, at a minimum, have midterm or long-term objective. And it's a sliver of their investable capital. It's not the majority of it. And I think that's where a lot of education can take place. I think that's where, again, conversations just like this are so good, because it does help to enlighten and educate the investor. And the more educated they are, then I think the better the asset class is in totality.
And if you look at any of these private market offerings, from real estate to private equity, private debt, there's a fair amount of opacity to them. But, and again, maybe this is my generation, but I think the consumer in this consumer-led economy is used to the illiquidity of real estate just by their home buying habits. So they're buying a highly illiquid asset, very little transparency around price discovery. Transaction costs are very high, and we lever it up many times over. So we kind of get that joke, so to speak. And if I could say to today's consumer, go down to this Brownfield project, and instead of putting 30% down on a house, put that down on the Irreplaceable Corner and pay rent in your apartment. And that money's not going to be locked up for a 30-year mortgage. It might be locked up for 5 to 7 years, and you may have some value to show at the end of it. So I think we could maybe tell this story through maybe some lines that they're used to and maybe get them to the right place, but we'll see what comes of it. But I think putting education ahead of any investment makes a lot of sense. And we talked right before we flipped on the microphone about this Sam Zell quote, which was, I saw in the Financial Times just yesterday, that there's no value without liquidity. And he's right, ultimately, and this is a business you're in, Chad, at the end of whatever holding period, you have to have a buyer, otherwise you have no value realized. But the same is true. I think there's no value if you've got liquidity on demand either, particularly an asset class that's not meant to have liquidity next day, next quarter, next anything. If you're not talking about anything, it's not measured in 3 to 5 year increments at a minimum.
That's right. And I think what's interesting, and it fits directly within those two quotes that you just indicated, is I think illiquidity can also save an investor from their emotional turmoil. You know probably better than I do that a lot of investment decisions can be made on emotion, and you can end up losing a significant amount of money, a lot of wealth, by making emotional investment decisions. So when you do have a little bit of illiquidity in the portfolio that maybe you can't access on a daily or a quarterly basis, it keeps a little bit of that emotionality in check and allows you to then maybe make some spending decisions that you otherwise wouldn't if you did have full or free liquidity. It allows you or forces you not just to read a headline and react to it, but actually kind of navigate through that. So I agree with you. Ultimately, there does have to be liquidity or there is no value. But having too much liquidity, I think, can also be a challenge for folks as well.
Yeah, I agree. So, Chad, maybe just in the remaining minutes we have, a term I've not heard in quite some time, at least a few years, is opportunity zones. And this used to be 24/7, talking about the tax advantage rollover and the concept of the economic value you're bringing to a sector. And I always had some challenges understanding the value proposition because I think many times the rollover benefited the investor and maybe not so much the economic zone you were going into the first place, because I think it pushed many of the people living in that economic zone one further zip code out. But maybe that's beside the point. I know there's legislation attached to this, but are opportunity zones still a thing? And was that ever in your wheelhouse in terms of product offerings?
Never in our wheelhouse. We've kind of taken the approach of not chasing the flavor of the month, so to speak, but staying tried and true to our investment thesis. I think there's a lot of folks out there that they got caught up in the allure of the opportunity zone and probably chased some deals candidly that didn't make sense. I think opportunity zone in totality was a little bit politicized as well, but again, we won't chase that rabbit necessarily. But I think when you really peel the onion back on opportunity zone investing in the length of time that your capital is tied up, that it all had to be capital gain going in. So there's a relatively significant limitation to it that really caters to the uber wealthy as opposed to maybe more of the common investor. And then you basically had to double your investment by improving that opportunity zone asset, created some hurdles to it that were really targeted just to a small, finite piece of the investor group. And like you, there was a lot of buzz around it when it first came out a number of years ago. But in the last 2 or 3 years, I have heard very little about opportunity zones, both on the development side or on the investor side. So I don't think it had quite the splash that was anticipated. I know and I'm sure that there were a number of good opportunity zone investment opportunities that were out there, but I think they're few and far between today, at least that we hear and in the circles that we run in.
To be continued on that subject, but it seemed to be topical given the space you're in. Maybe we'll leave it at that, Chad. We're coming up against time, but Kaya does have a series of micro credentials we brought out. We did one on private debt and digital assets late last year. And my colleague Aaron Philback is doing this on this product called Unify. This discussion is very timely and topical because the next one out I think just in the next couple of weeks is going to be on real estate and trying to bring more transparency to the RIA, who's now got either the high net worth individual and maybe the more average retail investor knocking on the door and saying, how do I access real estate? And first off, I think that's a loaded question because what do you mean by real estate? It can mean a lot of different things, and understanding their risk tolerance and their investment horizon, et cetera, et cetera. These are very, very important. So discussions like this are very, very helpful because our goal is to not put up a block and say, do not invest. Quite the opposite. We're putting up a block called education. Get over that, and then the world can be your oyster. And I think we're in a very interesting time, particularly in real estate across all sectors. There's a lot of disruption, maybe in some cases, some destruction of value. But when you have this type of a market, it presents some very, very interesting entry points if you can be a liquidity provider. So you've got to do it with your wits about you, with the right partner, RIA, GP, or somebody else. And I think if your goal is to invest in the long term, this could be a very, very good time to invest.
Totally agree with you. And I think it's important for folks to look and think both about the macro and the micro. And at a macro level, for example, quickly in retail real estate, we are at such a supply-demand imbalance right now. We're leading up to the global financial crisis in 2008. As an industry, we were building 60, 70 million square feet of retail every single year. And with the global financial crisis, that literally fell off a cliff. And since about 2010, we've only been building somewhere in the neighborhood of 7 to 10 million square feet of new retail property a year. And you've had retail property being demolished. And as you look at the forecast for a variety of reasons, that trend line isn't going to change. So again, at a macro, there's significant tailwinds because of that supply-demand imbalance that has really driven occupancies up. It has given us very good rent growth. It's given us expansion in retail tenancy. So from a macro, I think those are some of the themes. And then at a micro, knowing who you invest with, what the strategy is, what the track record is, and does that strategy meet with what your objectives as an investor are, either for income or long-term appreciation, taxable, non-taxable, all of those things. So I would just close with, I very much appreciate what you do, the way you do it, the education that you provide, and the ability to, again, make things like real estate or private credit or debt available and just a topic for people to talk about. So thank you, and thank you for the opportunity to just join you today.
Well put. Thanks again, Chad. I enjoyed the conversation.
Thank you.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CAIA Association and subscribe to the show at caia.org. That's CAIA.org. See you next time.